Good day, everyone. So our lesson for today is about financial ratios. So what is financial ratio? Why is it important? And what is the formula for commonly used financial ratios? Okay. So the following explanation will help in understanding each finance function in general. So what are financial ratios? Ano ng financial ratios sa ginahambalta and why is it important? Financial ratios are created with the use of numerical values taken from financial statements to gain meaningful information about a company. The numbers found on a company's financial statements, which includes the balance sheet, the income statement, and cash flow statement, are used to perform quantitative analysis and assess a company's liquidity, leverage, growth, margins, profitability, rates of return, valuation, and more. So basically, financial ratios helps businesses or companies to determine their performance because syempre we could not easily say na okay yung performance ng company, no? We need some basis. So the most credible information or source of information of stating the performance of the company is the financial statements. So I know that you already know how to create or to draft financial statements. Kahit na yung mga basic lang, like we have the balance sheet, the income statement, and cash flow statement. But again, that is a presentation of the financial performance of the company. But with that financial statement, we can use the information there in order for us to determine how did the company perform in the selected period, or did the company perform good, better, or best, diba? Or not good. So the information in the financial statement using the financial ratios will help determine how did the company performs. So parang nagiging basis na ng company yung financial statements nila. Because again, the financial statements will just be about the account titles and the numbers. But if we will employ financial ratios, then that financial statement or that information from the financial statement will be very useful and will be very helpful for the company to determine its performance. Okay? So financial ratios are grouped into the following categories. We have the liquidity ratios, the leverage ratios, the efficiency ratios, the profitability ratios, and the market value ratios. So, who is using or what are the users and who are the users of financial ratio analysis? So, sinong mga tao yung nag-give ng importance to financial ratios? Okay? Or the uses of financial ratios. Let's talk first about the uses of financial ratios. Number one of the goal of the financial ratio is to track company performance. So as I have explained kanina, no? So financial ratios determines individual financial ratios per period, and tracking the change in their values over time is done to spot trends that may be developing in a company. For example, an increasing debt to asset ratio may indicate that a company is overburdened with debt and may eventually be facing default risk. So basically, financial ratios are being used to compare to the previous performance of the company. So for example, today is 2022. So the financial ratios coming from the financial statements of this year will be compared to the previous years, whether nag-okay ba ang performance ng company this year or not. So that's one of the common objective of financial ratios. Ma-compare niya. Like for example, okay ba ang performance ni company last year compared this year? So With that, ano ang magiging action ng management or ng company to have a better performance to the succeeding financial year. So parang ganon. It will help since alam ni management or ni yung decision makers na mas maganda yung performance nila last year. So of course, they will determine ano ba yung ginawa nila last year na hindi nila ginawa this year na mas okay yung performance na last year. Then maybe the company will employ yung mga best practices na last year for the succeeding years because the financial statements through the financial ratios indicate that their performance of the previous years are better than this year. So parang ganun ang concept. Next, we make comparative judgments regarding company performance. So comparing financial ratios with that of major competitors is done to identify whether a company is performing better or worse than the industry average. So for example, comparing the return on assets between companies helps an analyst or investor to determine which company is making the most efficient use of its assets. So let's define first ano yung tinatawag na industry. So an industry is a group of businesses with the same type of business. Like for example, pharmacies, di ba? So if you are a pharmacy or butika, syempre you belong to the pharmacy industry, which means yung mga members doon, lahat ng mga pharmacies or butika sa whether sa inyong munisipyo or city or sa province, sa region, sa whole country, so ganun. So you are a member of the industry that you have the same business. Parang ganun. So syempre, yung kanina, yung sa track performance dito sa previous slide, kinompare natin yung performance ng business within the previous performance inside the company. Yung dito sa may comparative judgments, we are already now comparing ang performance natin compared to our competitors or to those businesses with the same type of business that we have. Kasi we will determine na ay mas okay yung sales ni ganito compared sa atin. So ano ba ang ginagawa ni competitor na hindi ating ginagawa? Why is it that their performance is better? So parang ganun. So, who are the users of financial ratios? Users of financial ratios include parties both external and internal to the company. So, syempre, when we say external, it is a person or a group of people or companies that is not directly involved with us, di ba? So, ang internal is yung nasa loob na company. So, we have the external users, the financial analysts, the retail investors, okay? Creditors, competitors, tax authorities, regulatory authorities, and industry observers. So for example, sa investors, why is it important for an investor to know the financial ratios of the business? Kasi it will dictate now yung dito na purpose. They can determine whether that business is performing compared to its competitors. Kasi kung mas okay yung performance ni competitors, doon ako mag-i-invest, di ba? So usually, external users of financial ratios are here. Dito na purpose ang kailangan nila, bakit nila kailangan yung financial ratios. Yung internal naman, can be here sa track company performance and sa may comparative judgments because they will, of course, they have the responsibility or the burden to improve the performance of the company. So sa internal users, we have the management, the employees, and of course, the owners of the company. So what are the commonly used financial ratios? There are actually hundreds of financial ratios, but here we are going only to discuss the most common. Yung talagang kapag sinabing financial ratios, dapat alam mo itong mga samples na to. Okay? And then, in our discussion, I will deal more of why is that certain financial ratio important and not basically on on the computation because I know already that you have learned the computation in your accounting subjects. I know that you know what are those account titles. Ano yung mga account titles na yon, di ba? So you already have the background of what those account titles or the elements of those ratios are. So I will discuss more on the importance of that certain ratio. Okay? So let's start first with liquidity ratios. Liquidity ratios are financial ratios that measure a company's ability to repay both short-term and long-term obligations. So, syempre, here in the liquidity ratios, we are dealing with how liquid the company is. Ibig sabihin, ano ang capacity ni company makabayad sa iyang mga utang? Both short-term and long-term. Di ba? May capacity ba si company to pay? So, of course, it is important sa internal users. Sa external naman, syempre, ito yung kailangan ng mga creditors, di ba? Example, financial institutions, if ever mag-apply tayo for a loan. So, that is why financial institutions like banks and creditors, yung mga financial institutions, require financial statements because they are going to study how liquid the company is. So let's start with current ratio. The current ratio measures a company's ability to pay off short-term liabilities with current assets. Because again, we know that short-term liabilities should be paid at most 1 year, di ba? That's the idea of short-term. So, what is the capacity of the company to pay yung mga short-term or immediate nila nga barayda nun? So, ano ba ang capacity ni company? So, we can compute that by dividing current assets over current liabilities. So, syempre, in the balance sheet, meron di ba current assets, may current and non-current assets. Sa liabilities, may current liabilities, may non-current liabilities. So, simply, yung total ni current assets, i-divide lang natin sa total ni current liabilities. Okay? Let's go now with acid test ratio. Sa acid test naman, acid test ratio measures a company's ability to pay off short-term liabilities with quick assets. Mabilisan na asset. So, of course, we can compute it by current assets. Ima-minus natin si inventories because inventories can be a current asset but it is not considered as quick asset. Buti nun, hindi mo siya, it is not convertible to cash or cash equivalents in a short period of time kasi kailangan pa natin siya i-dispose. Whereas yung ginatawag natin yung current nga acid test is yung mabilisan talaga na kahit na hindi mabenta yung inventories, we can still, the company can still have the ability to pay its current liabilities. That is why we are deducting inventories from the current assets. Hindi natin siya sinasali sa computation sa acid test ratio. Next, we have the cash ratio. The cash ratio measures a company's ability to pay off short-term liabilities with cash and cash equivalents. So simply, cash ratio is cash and cash equivalents divided by current liabilities. So of course, you already have an idea ano ang cash at ano ang cash equivalents. So basically, it is not the total of the current assets. Pero si cash at cash equivalents, i-divide natin si current liabilities, we can have the cash ratio. Because again, cash is the most liquid asset. So ito na yung talagang we can pay it immediately. So that is why tinatawag siya na cash ratio. The operating cash flow ratio is a measure of the number of times a company can pay off current liabilities with the cash generated in a given period. So operating cash flow ratio is equals to operating cash flow divided by current liabilities. So how many times can we pay our current liabilities? Ilang beses? Can we pay our current liabilities twice, thrice with our current financial standing? Ganun. So that's also very important. Siyempre, the more capacity to pay or the more number of times a company can pay of current liabilities will be a very good sign that the company is very liquid. So kung ako ang creditor, kung uutang si company sa akin, kapag malaki or mataas yung operating cash flow ratio niya, though basically it is a good sign that the company can able to pay if ever maglo-loan siya. Di ba? Parang ganun. Let's go now with leveraged financial ratios. Leveraged ratios measure the amount of capital that comes from debt. Di ba? We know that a capital can either be through stocks or through equity or through debt. Di ba? As we have discussed in our previous discussions, yung prelim, we know that it is not good that a company's capital requirement will come only from equity or will come only from debt. Pero there should be a balance. So here in the leverage ratio, we are going to determine how much capital comes from debt. In other words, leverage financial ratios are used to evaluate a company's debt levels. Common leverage ratios include the following. We have debt ratio. The debt ratio measures the relative amount of a company's assets that are provided from debt. Diba? How much of the total assets or how much of the total assets ang gin-finance sa utang. So for example, kung may asset kang 1 million, pila sa 1 million nga na ang nag-finance na utang. Pila sa 1 million nga na ang finansang kapital. So, ganun. So, that's the debt ratio. The debt to equity ratio naman calculates the weight of total debt and financial liabilities against shareholders' equity. So, ano ba ang mas malaki? Ang debt or equity capital? Diba? So, which is higher? So, there should be an equal, not equal, but there should be a good balance between the two. Okay? The interest coverage ratio shows how easily a company can pay its interest expenses. So from operating income, gaano kadali or how available the cash is for the company to pay its interest na babayaran sa company. The debt service coverage ratio reveals how easily a company can pay its debt obligations. So debt service coverage ratio is equals to operating income divided by total debt service. Let's go now with efficiency ratios. Efficiency ratios, also known as activity financial ratios, are used to measure how well a company is utilizing its assets and resources. So syempre, from the word itself, from the name itself, efficiency, how efficient is the company? How good the performance of the company is in conducting its business, di ba? Kasi dito, sabi nga, how well a company is utilizing its assets and resources. So how good, di ba, ang management sa business. Let's start with the asset turnover ratio. The asset turnover ratio measures a company's ability to generate sales from assets. So from total net sales, i-divide natin ang average assets. So how good the company is generating sales sa asset nila. Okay? So that's asset turnover ratio. Gaano kabilis? The inventory turnover ratio measures how many times a company's inventory is sold and replaced over a given period. So from the name itself na turnover, gaano kabilis yung pag-purchase sa pagbenta ng inventory sa isang company. So inventory turnover ratio is equals to cost of goods sold. So I know you know already how to compute cost of goods sold. I-divide natin siya sa average inventory. So that's the inventory turnover ratio. The accounts receivable turnover ratio measures how many times a company can turn receivables into cash over a given period. So similar sa inventory turnover ratio, Pero dito, how fast lang na yung receivables ng company na nako-convert into cash. So, how good is the collection of the company of its receivables? So, syempre, kung okay yung receivables turnover, ibig sabihin, maganda yung performance ng company in collecting its receivables from its debtors. The days sales in inventory ratio measures the average number of days that a company holds on to inventory before selling it to customers. So gaano kabilis? So kung nagbakal subong sa isang inventory or nahimusbong ang inventory, how many days ang kinanglan before siya ma-dispose or before siya mabaligya sa customer? So 365 days, yun yung nagiging standard natin with when we say a year divided by the inventory turnover ratio. So kukunin natin yung inventory turnover ratio para ma-compute natin yung days sales in inventory ratio. Now let's go to profitability ratios. Profitability ratios measure a company's ability to generate income relative to revenue, balance sheet assets, operating costs, and equity. So how profitable the business is. Ganun sa profitability ratio. So the gross margin ratio compares the gross profit of a company to its net sales to show how much profit a company makes after paying its cost of goods sold, diba? Because the sales or the income of the company will really go, will arrive or maybe ma-achieve yung income ng company after natin ma-reach yung break-even point. So ano ang break-even point? I know that you already have an idea of what's break-even. So syempre, ito yung amount na kung ma-achieve ni company, wala siya sang lugi, wala siya sang income. Kumbaga pa sa layman's term, balik capital. Balik lang ang capital. Wala siya nalugi, wala siya naginansya. So, after na ma-achieve yung break-even point, that's the time pa lang that the company will have income. Okay? So, how much profit a company makes after paying its cost of goods sold? Yun yung tinatingnan ni gross margin ratio. The operating margin ratio compares the operating income of a company to its net sales to determine operating efficiency. So similar to gross margin. So operating margin ratio is equals to operating income divided by net sales. And lastly, the return on assets ratio measures how efficiently a company is using its assets to generate profit. So ROA. Di ba? Meron tayong ROI, may ROA. So return on assets ratio. We can compute it by dividing net income, our net income, over our total assets. So total, both the current and the non-current assets. And ito pa wala last. The return on equity ratio measures how efficiently a company is using its equity to generate profit. So similarly sa ROI, ROA, still ROE is net income divided by shareholders' equity. And that's the end of our discussion. Hopefully you gained some and learned something from it. Thank you and see you next time.